Right now, somewhere in America, there is a family that did everything right. They saved for years. They built their credit. They got good jobs. They waited for the right moment. And they still cannot afford to buy a house. Not because they are irresponsible, not because they made bad decisions, but because the housing market in this country has transformed into something that the rules they followed were never designed for. In 2020, the median American home cost around $260,000. Today, that same median home costs over $420,000. That is a 60% increase in 4 years. Wages did not go up 60%, savings rates did not go up 60%. The market did not crash. It was supposed to crash. Every expert, every model, every historical pattern said it should have crashed. Interest rates went from 3% to over 7% in less than 2 years. That has never happened that fast in modern American history. Every previous time rates rose sharply, home prices fell. That is how it works. In the next 20 minutes, I am going to explain exactly why that happened, who it actually benefits, what the math looks like for. After the 2008 financial crisis, the United States entered the longest period of low interest rates in modern history. The Federal Reserve dropped rates to near zero and kept them there for years. The logic was straightforward. Cheap money stimulates the economy. People borrow, people spend, the economy recovers. And it worked, mostly. But one of the side effects of a decade of near-zero interest rates was that it made real estate an extraordinarily attractive investment. When money is cheap to borrow and returns on traditional savings are near zero, institutional investors, large corporations, private equity firms, and individual landlords all began purchasing residential properties at a scale that had never been seen before. By some estimates, institutional investors own somewhere between 25 and 40% of single-family homes purchased in certain markets at the peak of this buying wave. These are not homes sitting empty. They are largely being rented back to the exact demographic that would otherwise be buying them. Young families, first-time buyers, people in their late 20s and 30s who in any previous generation would have been the primary engine of the starter home market. Then 2020 happened. The pandemic did something to housing demand that nobody fully predicted. Remote work decoupled where people needed to live from where their jobs were located. Suddenly, someone in San Francisco could do their job from Phoenix. Someone in New York could move to North Carolina. The geographic constraints that had previously concentrated demand in expensive metros began to dissolve. And simultaneously, the Federal Reserve dropped rates to historic lows again to cushion the economic blow of the pandemic. Mortgage rates fell below 3%. For a brief window, you could borrow money to buy a house at the lowest rates in American history.
What happened next was entirely predictable in hindsight. Demand exploded. People who had been waiting to buy, and between 2020 and 2022, home prices in America increased by an average of nearly 40% nationally, with some markets seeing 80, 90, even 100% appreciation in 2 years. Then, in 2022, the Federal Reserve did what it had to do. Inflation was running hot across the entire economy, and the only tool available to cool it was raising interest rates. They raised them faster and higher than at any point in recent history. In 18 months, the federal funds rate went from essentially 0 to over 5%. Mortgage rates, which had been sitting below 3%, climbed above 7% and stayed there. Everyone, including the Fed, expected this to cool the housing market. It cooled the transaction volume dramatically. Let me show you exactly what these numbers mean for a real buyer, because the abstract discussion about rates and prices does not capture how dramatic this shift actually is at the household level. In January of 2021, the median American home cost approximately $300,000. A buyer putting 10% down and financing $270,000 at a mortgage rate of 2.9% was looking at a monthly payment of approximately $1,125,000. That is principal and interest. Add taxes and insurance, and you are somewhere around $1,400 to $1,500 per month total housing cost. Now run the same scenario today.
The median home is $420,000. 10% down means financing $378,000. At a current rate of approximately 7%, that monthly principal and interest payment is $2,516. Add taxes, which have also increased because assessed values follow market values, and insurance, which has increased significantly in many markets due to climate risk repricing, and you are looking at a total monthly housing cost somewhere between $3,000 and $3,500 per month. That is more than double the 2021 cost for the same median home. Not a more expensive home, the median home, the middle of the market. Median household income in America grew from approximately $68,000 in 2021 to approximately $74,000 today, a 9% increase. Housing costs for a median buyer went up over 100%. These numbers are not compatible with each other. They do not resolve into a sustainable market. They create exactly what we are seeing right now, which is a market that continues to move, but only for a specific subset of buyers. So if the majority of potential buyers are priced out by traditional affordability standards, who is actually buying homes right now? The answer breaks down into three groups. The first group is existing homeowners who are trading equity. Someone who bought a home in 2018 for $300,000 and watched it appreciate to $500,000 has roughly $200,000 of equity they can deploy into the next purchase. That equity cushion changes the math dramatically. They are not starting from scratch. They are rolling forward a substantial down payment that can bring the loan size, and therefore the monthly payment, into manageable territory. This is a significant portion of current transactions. The second group is high-income households. The distribution of income in America has become significantly more bifurcated over the past decade. While median income growth has been modest, income growth for the top 20% has been substantially stronger. For a dual-income household where both partners have professional careers and combined household income is in the $150,000 to $200,000 range, the current mortgage payment, while painful, still falls within a manageable percentage of income. These buyers exist, they are active, and in many desirable markets, they are the primary competition.
The third group is cash buyers, which includes both institutional investors and wealthy individuals. In the current rate environment, not having a mortgage is an enormous competitive and financial advantage. Cash buyers make up a larger share of transactions than they have historically, particularly in certain price segments and markets. When you are not paying 7% interest, the affordability calculation looks completely different. What is notably absent from this list is the group that has historically driven the first-time buyer market: young adults, millennials, and now older Gen Z buyers in their late 20s and early 30s, who are at the life stage where homeownership has traditionally made sense. These buyers are not absent from the market entirely, but they are significantly more constrained, more geographically flexible. There is another dynamic operating in this market that most mainstream coverage glosses over, but which is arguably the most important structural factor keeping prices elevated. It is called rate lock, and it explains why the usual relationship between rising rates and falling prices broke down this time. The overwhelming majority of existing homeowners in America who have a mortgage right now are locked into rates below 4%. Many are below 3%. These are mortgages they took out or refinanced between 2020 and early 2022, when rates were at historic lows. On a similar priced home, your monthly payment would nearly double. Even if you genuinely want to move into a larger home, a different city, something that better suits your current life, the financial cost of giving up a sub 3% mortgage and picking up a 7% mortgage is so severe that millions of homeowners are simply choosing to stay put. This is rate lock, and it is creating an inventory crisis that is compounding the affordability crisis. The homes that would normally be coming to market as families upgrade, downsize, or relocate are largely staying off the market because the means for supply. Before 2022, existing home sales ran at approximately 5 to 6 million units per year. By late 2023 and into 2024, that number had fallen to approximately 3 to 3.5 million units per year.
Fewer homes for sale means any buyer who is active in the market is competing over a dramatically smaller pool of available inventory. And basic supply and demand means that prices hold, even when affordability deteriorates. The rate lock problem does not have a quick fix. Rates would need to fall substantially, back into the 4 to 5% range at minimum, before a meaningful number of locked-in homeowners would be willing to give up their current rate. And even a significant rate drop would only gradually free up inventory, as it takes time for homeowners to make decisions, list homes, and transact.
After 2008, home builders were so severely burned by the crash, some of the largest builders in America went bankrupt, thousands of smaller builders simply ceased to exist, that the industry spent the better part of a decade building significantly below the rate needed to keep up with household formation. America adds roughly 1 to 1.2 million new households per year through a combination of population growth, immigration, and young adults leaving parental homes. For the past decade, new construction has consistently run below that rate. The result is a structural deficit of housing units that various economists estimate at somewhere between 3 and 7 million homes nationally. That is not a gap that closes quickly. Even if builders were running at maximum capacity, which they are not due to labor shortages, material costs, and land availability constraints, closing a multi-million unit gap takes a decade or more.
Builders are not in the business of losing money. When the cost to build a home approaches or exceeds what buyers can pay, building slows or stops in that segment. Builders are naturally gravitating toward the higher margin move-up and luxury segments, which leaves the bottom of the market where the most buyers are with the least new supply. This is particularly acute in the starter home category, which is precisely where the demand is highest. Building a modest first home that sells for $200,000 to $250,000 is increasingly uneconomical in many markets because land, labor, and materials alone approach
Scenarios that most serious analysts are working with, and I want to walk through each of them honestly because the range of outcomes here is genuinely wide.